Hey guys, welcome to Ink Money, the place where we're going to learn and talk about money. So, I'm here with Brian. We're going to be talking about how the economy's crashing under Trump, see what potential plans are, maybe going on here soon, hopefully. With hopefully something smart he's planning because the market has taken a pretty deep dive. So yeah, let's talk about it. We have here the SPY ETF, and this basically just tracks the market, right, Brian?
Yep.
Since about February 10, about February 10, market seems to have taken a pretty steep dive here. It's pretty steep.
It's roughly 10%.
Okay, thank you. Roughly 10%.
It was peaked out at 610, 611, actually, I think. And right now we're trading at about 560.
Yeah. You might need to talk closer to your microphone there.
Yeah.
Yeah. There you go. What's been going on? Why is the market crashing like this under Trump? I mean, we were promised a better economy, right?
Yeah.
Is it the tariffs?
So the tariffs are a catalyst for sure. But there's a whole bunch of different things going on here. The number one thing, people are a little scared of those tariffs. And then there's a few other factors. Trump has discontinued a lot of government funding for funds that were kind of keeping the economy afloat. He's cutting federal jobs and all of that. And so that, along with an already weak business environment, is basically just starting to take its toll.
Why was it a weak business environment so far? Like, what's been going on?
Higher Fed funds rate really drove a lot of it.
Higher Fed fund rate. Okay.
Because it's making money more expensive. So
Gotcha.
that's making capital investment more difficult, which is driving down the amount of investment in the economy right now.
Gotcha. So high interest rate from the feds create this. Basically, people are not willing to take as much risk because they're not
unable to take as much risk just because it's financially impossible anymore.
Gotcha. You think there's a plan going on here, or is Trump is he a complete idiot? Like, why is the market completely crashing? If maybe there's something we could do to, I don't know, maybe benefit from this market crash.
Yeah, so that's a good question, Charlie. So there's a couple of things going on here. First of all, the market is crashing somewhat because Trump is taking a more financially responsible perspective on a lot of things. So that's helpful. And then things we can do to help protect us against this housing crash. Or against this crash. So one of the things we can do is just hold more cash. Warren Buffett does that, and I think he's one of the best in business. So copying his moves are probably a fine thing to do.
If you already had your money in the market in this crash, do you think it'd be a good time still to pull it out and just wait?
There's time to do that. Yeah, it's only down 10%.
Okay. By the way, this is not financial advice. We're not financial advisors, but we're just here to learn. I'm here to learn, really, and Brian's here to help teach me and help teach you guys too. And so right now it's a good time to hold cash, buy the dip, as a lot of people say.
Yeah, there's some argument for buying the dip right now. Personally, I'm not doing that yet, but I may be wrong.
Okay. Regarding for those of us, so this is really a good time for people who are younger, who weren't able to get into the market while it was still high.
I wouldn't go that far.
Right? No? Okay.
So the past 3 or 4 years have been terrible for us because we're not making enough to be able to purchase houses. And then you got the price rate or the price increase from 2020 on of houses where they just shot up to 50% higher.
And the price increase of everything in general.
Yeah, price increase, general inflation is difficult, but especially in housing. And then the other thing that's really screwed us is that rate increase that started in about 22, I think is when that started. And so when the Fed started raising rates, all of a sudden now houses got twice as expensive monthly as they used to be on.
When do you think the Fed will ever drop their rates, or
guarantee it?
Okay. By when? When's your prediction?
I don't want to make that call.
Okay. Do you think it'll be sooner than later?
I do.
Okay.
I think the Fed is behind the curve, and I think they've been behind the curve since the start of it. So,
why do you say that?
So they should have raised rates sooner after COVID, and they should have started cutting rates a little sooner than they have.
Okay. They were also printing too much money too, right?
That was the Treasury, I believe. I think the Treasury is working against the Fed for a lot of this, which is part of the reason we're having so much economic pain.
Okay. So you don't think we're at the bottom yet of the market crash?
I don't believe so.
Okay. How much longer do you think we're going to be going through this?
So the current PE ratio of the stock market is showing us 24.
What does that mean?
So total earnings per share of the S&P right now is at a certain rate, and that actual price of each share of the S&P of the SPY ETF is trading at 24 times that earning. So in other
Oh,
words, it would
shoot.
take 24 earnings to pay off your stock position.
So you're saying that right now things are priced too high.
Yeah, a fair earnings ratio is about 15.
15. So 15 times higher than your earnings is what
Yeah,
a share
it's
should
about
be.
what it should be for a fair
Okay.
price.
Okay.
About $10 is what Warren Buffett would consider, or about a PE ratio of 10 is what Warren Buffett would consider a decently good investment time. And anything over about 20 is starting to get overheated. One other factor for this is earnings go down in a recession, right?
Mm-hmm.
Prices also go down in a recession, so you get this negative spiral. So to chase a PE ratio of 12, which is kind of what I would consider to be the bottom of the dip, is what I'm expecting here. We're gonna see some earnings loss, which is going to lead to even more price loss. So we're not even looking at maybe a 50% drop here. We might see up to like a 60 or 70% drop by the time we actually tap bottom.
So Brian, why is the stock market exactly due for a pullback right now?
So that's a good question. So the actual answer stems from what has happened in the stock market up until now, and then that will explain why we're due for a pullback. And so what's happened is over the past few years, we've had all this enthusiasm around AI, we've had overheated inflation, and we've had reduction in people's spending as far as what they need to spend on like student loans and so on, because those were all deferred payments.
Oh.
And so we've had lots of money that's just flowed into the stock market. And like anything else, if you have too much money chasing something, it goes up in price. And now that we're back to having to pay student loans, housing's getting more expensive, and so on, people are going to start seeking to pull money out of the market. And I think that's what we're seeing right now. I think we're seeing people, conscientious people going in and pulling their money out. And what happens is over time, that becomes a self-reinforcing policy, so that as people start pulling more money, they see the amount of money they have going down, so they get more aggressive at removing it from the market. And that turns into a self-reinforcing crash.
Gotcha. What usually stops a crash from continuing?
So at some point, it gets so cheap that everyone wakes up and realizes, oh, we can buy in again, and we're going to start putting money in. Recently, that's also coincided a lot with the government handing out extra money.
Gotcha. So yeah, that brings me to my next subject regarding Doge stimulus checks.
Yep.
And it looks like Elon Musk was saying that maybe the government will be cut back far enough so that we get a quote unquote refund from the government for the tax dollars we've given them and the overspending that they've been doing.
Yeah.
And now he's cut back and saved the government money. Do you think that's a possibility potentially?
Yeah, I think for sure.
Why do you say that?
So,
and if it does happen, actually sorry, I guess I'm jumping ahead a little bit. The market's crashing. It seems like Trump is allowing it to crash. He's not really putting pressure on the Fed to print money right now. Your prediction, and we talked about this before, is that potentially there's going to be the stimulus check here in about 6 months or so, roughly. No, don't take our word for it, but why do you think it's possible for them to actually give out a stimulus check like that?
yeah, so we all knew going into this last election, I think, that anyone who was realistically involved in the economy and bought groceries, had a job, etc. So if you weren't on TV talking about it, in other words, paid to say something else, I think we all knew the economy was in bad shape. And Trump got handed this economy, and he's going to get blamed for whatever happened. So what he's doing, I think, is pretty smart, where he's allowing the economy to kind of take its own course here, because to course correct would be a deficit probably of up to $5 trillion this year, just to keep things moving. And no one wants to do that.
What are we currently at? What is our...
About $2 trillion. Yeah, the government pays in roughly like $4.5 trillion a year or so.
Yeah,
and we're spending 6.5 to 7.
Oh, yeah, that's okay. So that's the amount that the debt is increasing by. Okay.
So yeah, to keep this economy going, we'd have to print about $5 trillion extra dollars, is my best guess, because we had been printing about $2 trillion, and we're starting to see, if you go back to the S&P, you can see where we started printing $2 trillion extra, and we got this really quick ascent in price over the. Yeah, you need to go out to the 5-year chart.
5-year chart.
Yeah. So you can see here in about 21, we continued that $2 trillion deficit spending, We got that shooting up price. The Fed started to increase rates in 22. We saw a kind of a real pullback there. And then Biden kept a whole bunch of relief measures on the economy and continued deficit spending. And so then we kept the economy overheating. But then in 23, you can see where the economy starts to round over. And so it goes from upwards momentum to starting to gradually level off. And now you can see that chart has double topped rather, and is now heading back down. And so what that means is we're starting to return to a more realistic economy rather than just a spending-based economy.
Okay. So that's a good thing.
Yep.
Potentially, right? If you believe in free market capitalism,
Yep.
if you believe that it's going to be better for people that don't have a whole lot yet, right? And
Yeah. So the bifurcation point that we went through in 23 was prior to 23, we were on a direct path to a Soviet-style financial control.
Okay. Explain that further.
So in order to keep that kind of market control they had, they would have had to start synthetically controlling everything, because you can't just keep pumping money into the markets like that without just driving inflation out the roof.
Gotcha. Because it's fake money. There's nothing really backing it up. And then when you have a whole oversupply of money, then prices go up because there's more demand for things because people have more money to spend. So, okay.
So there's a lot of that going on in this chart.
So Doge is trying to cut a lot of stuff from the federal government right now, from the federal spending, which potentially could then lead to this refund without them actually having to print more money. Is that correct?
Yeah, so it'd be more or less a tax return rebate.
Got it. Yeah, that makes sense. And then, I'm just going to show, here we have the Doge website. They're actually showing more stuff now. They're showing where all payments are being processed. Do you think long term, or do you think Trump's economy is going to be back to booming here in about 2 years then?
My expectation is within a year.
Within a year?
I think so.
You think we'll have that fast of a correction?
I believe so.
Oh.
And now it may not look like that, because one of the things I anticipate that he'll probably do is his deregulation and reduction in government spending, I believe, will both continue. So we're going to have much more real growth. And so unlike the last 4 years, it's going to be less synthetic. So it'll be less linear, maybe actually a lower stock price, but we're going to have more consistent actual organic.
Okay, so that means more innovation potential. There's more chances for actual jobs being given to people in the private sector, whereas obviously the federal government's not going to have as many job opportunities. Some people might argue with the rise of AI, though, jobs could be taken away from, or there could be less jobs in the private sector. I'm thinking that we're probably going to move to a place where people can start their own small business a lot easier because they have their own AI agents, or they're able to leverage the AI systems in a way that actually makes them very productive on their own. And so now you have multiple small businesses in the economy, a lot more small businesses in the economy, and that actually then benefits the consumers, right? Because there's more competition.
Yeah. I can't say for sure what it looks like. What I can say, though, is Americans like money, and we're very innovative. So the odds are we're going to figure out how to make the money in this new environment.
Gotcha.
And I think that Trump's deregulation policies and so on are supporting that. They're going to make it even easier.
We haven't done a whole lot of research on what he's deregulated. Do you have anything that comes to mind? That the energy sector obviously is being deregulated?
Yeah, so reducing the price of energy. He also has a standing policy on the books where for every new regulation, 10 old ones come off. So just doing things like that, and it's really innocuous things you would never notice. Things like maybe the emissions cap on a car manufacturer could be reduced. That's not something that you or I would ever notice, but it's something that would help free them up and make their manufacturing process more straightforward and open up the possibility of some new types of vehicles.
That'd be cool.
Mm-hmm.
And I mean, he's also trying to bring back more manufacturing to America through his tariffs, supposedly, right? So,
And the integration of manufacturing, along with the engineers who design it, it's a vastly improved process to do
Gotcha.
that all in house. For the most part, it ends up with a much better product. There's some cost benefits if you're doing a lot of one type of thing where you don't have to do a lot of R&D. That repetitive manufacturing can be outsourced easily, but for a lot of the stuff that's higher tech, having that R&D work closely with manufacturing is actually hugely beneficial.
So you think it's overall going to be beneficial to everyone in America?
So deregulation and financial conservatism are both hugely beneficial to everyone in America.
Okay. Well, some people might argue it's just beneficial for the billionaires who already own everything.
Yeah, but here's the thing. So over the last 4 years, the billionaires got far richer.
That's true.
The average people got far poorer under the most progressive government we've had.
That's true. Why is that?
That's because vast government spending goes to the top.
Why does it go to the top? What leads it going to the top?
Bottom up economics.
Bottom up economics. So some people might argue top down economics is what benefits the billionaires, and that's what I have discussions with other people about.
Well, look at American history. We tried bottom up economics for 4 years. It made our billionaires far richer and our working class far poorer.
What is it about the bottom up economics that leads to that happening?
So it's because of the injection of capital, I believe. If you give average Joe money that he didn't work for, he's going to lose it. If you give a billionaire money they didn't work for, they're likely to lose it. And so this whole value of money thing, I think it just comes down to psychology. And so if you have your average middle class person working for their money, they're going to be much better at managing it than someone who's just handed it. And so if we minimize handing money to people, that's generally leads to better philosophy, better economics. I heard recently that the bottom 60% of American society all makes the same amount of money.
Yeah,
roughly.
That's interesting. Yeah, that makes sense.
Yeah.
That's why we're struggling. Like people who are just getting into the workforce are struggling to find housing affordable for them right now, because I've looked at some videos and charts that claim that the average housing cost in like the 80s was like $80,000, right? But people were being paid like $20,000 to $30,000 on average.
Yep.
And now the average pay for people is $60,000, but the average housing price is like $300,000 to $400,000. So there's like a 6 times difference from our pay now than there was back then,
and
more than that actually.
When that corrects, it's going to be exciting to watch.
Yes. It may not be good for people who own home, or is good for people who own their homes right now.
It will be painful for the entire economy.
And you think it's going to correct in the next 6 months or next year?
So I think this stock market dive we're seeing is the catalyst that I believe will unveil or unravel the housing market.
Okay.
Because if you have investors who are kind of that last prop holding the economy alive right now, rental prices are down, stock market prices are down, and that means that investors are going to start getting skittish. And when investors get skittish, that's the last thing that starts to fall.
All right.
The
housing is the last domino.
Well, that will be the catalyst that drives housing down.
Okay. Well, I'm excited for that personally, because I'm young and still poor and don't have my wealth built up. But
I mean, if you think about it though, housing is something like $50 trillion worth of value or something in the U.S. right now. So I mean, if you wipe half of that value away, which is about what it would have to be to get down to 2 to 3 or 3 to 4 years of income required to pay off your home, that's a huge amount of money lost. So it's not going to be a fun experience.
But rental prices should go down then. For
prices on everything will likely go down. So 08, 09, and then the 2000s, we saw prolonged periods of higher inflation due to growth, and then they were followed by periods of actually deflation where the dollar actually got stronger. And we're starting to see that. The inflation for February came in lower. And I think if we continue on this dive in the market, we're going to see eventually zero or negative inflation.
Right. Is there any correlation between what we're going through right now and like the Great Depression though? Because didn't they have a similar market high in the Great Depression, and then or before the Great Depression in the Roaring 20s, and then it just dived? And what led to that? Is there any correlation there?
Yeah, so the Great Depression isn't the greatest analog. I think a lot of people kind of are looking back to it because it's such a bad time. But that was America before we were superpower. We were on a gold currency, so it was more difficult to print money and get out of things. And so the modern equivalent to that, just there's no analog necessarily.
Okay.
So I believe we're going to see a more violent version of '08.
Oh, really? You think it's going to be worse than '08?
Every single fundamental is worse. Housing is worse. The stock market's worse. Everything's more overvalued than it was.
Oh, well, that's not good. But in '08 there were subprime loans and fake, basically these loans that nobody could pay back that were loaned out to people, and that's what led to this bubble, or that were sold to, like, not loaned out to people, that were sold to people, and then that's what led to this bubble and this giant crash,
But
right?
all it takes to turn the entire market right now, like from what it is currently into that, is loss of value of your house and loss of a job.
Gotcha.
So unemployment shoots up and housing market starts coming down, both of which have started. We can rapidly re-enter that.
So basically, try to keep your job or find a
Yep.
job that's valuable, some skills that people
Yep.
need, and then try to save your money.
Yep.
Be frugal, live within your means for this next year or so,
Yeah.
and yeah, and hopefully like things will work out and you can start investing again once the year's up.
And be aggressive when everyone else gets scared. Right now, people are just starting to get scared, so it's just about time to start thinking about being aggressive.
Yeah, when there's blood in the streets, that's when you buy, right?
Exactly.
Yeah, that's good. That's good to know. Thanks, Brian. I appreciate you helping explain some of this. And yeah, guys, if you guys want to subscribe, like, follow, do all the stuff, leave a comment in the comment section as well. Thanks for watching our channel, and we'll see you in the next video. Have a good one.